Many people have been asking the same question recently. In a global environment where gold prices keep rising and central banks continue to accumulate gold, why would a company holding one of the largest gold resource bases still trade at a relatively low valuation? This kind of mismatch is actual. Why worth breaking down? Taking Shandong Gold as an example, it holds more than 2,000 tons of gold resources, which is significant even on a global scale. Yet the market has remained cautious in pricing it. Part of this comes from historical factors and part comes from expectations. If we look back, the industry-wide disruptions in 2021 had a deep impact on many mining companies, with production declines and cost spikes shaping investor perception. These short-term shocks were amplified at the time and left a lasting impression on how the market views stability. But if you stretch the timeline, those disruptions often become the starting point for restructuring and upgrading. The real shift began after 2025, when a new management team stepped in and started to realign the company's strategy. The direction became Elb era, focusing on domestic resource consolidation while accelerating global expansion and using large-scale capital investment to build future product capacity. Projects like Jiaojia and Sanshandao are not just about increasing output, but about deeper resource development and technical capability, especially in deep mining, which directly shapes long-term production potential. At the same time, overseas projects are gradually changing the company structure, moving it from a regionally focused resource player to a more global mining company, something already visible in operations. Ghana. One key point that is often overlooked is that the value of a name company is not fully reflected in current profits, but rather in its reserves and the timing of future capacity releases. If you look ahead to the period between 2027 and 2031, this could be a critical phase where multi-P projects come online, potentially leading to a noticeable shift in production and cash flow. There is also an interesting dynamic around cost. Costs have traditionally been seen as a disadvantage, but in a rising gold price cycle, they can actually become a source of profit leverage because when gold prices increase, higher cost producers tend to see a more pronounced expansion in margins. From a broader perspective, the current gold cycle is tied to changes in global asset allocation, with some countries adjusting reserves and increasing their demand for gold. This is not a short-term shift, and it suggests that gold prices may remain elevated. In such an environment, companies with strong resource bases, clear expansion pipelines, and relatively low valuations may present a structural opportunity. I'll say, there are still uncertainties, including project execution, cost control, and overseas operational risks, all of which can affect outcomes. But logically, when resource integration, production growth, and a favorable price cycle align, it often leads to a reassessment of value. In simple terms, the real story of this kind of company is not about where it stands today, why, but how the market will reprice it as its future capacity gradually comes into reality.